Okay, go ahead.
Good morning, everyone. Good afternoon. It's good to see you. It's Friday, August 8th, and we are here to talk about becoming your own banker. And we're going to be talking about the details of it, the how, the what, and I'm going to especially talk about the why. So you want to have a good reason for doing anything that you're doing. And there are many, many people out there on the internet, many of whom are vital, intelligent, equipped, well equipped, credentialed, honest people who are doing a good job. And then there are also some people who are selling something, and they're selling something with a particular twist, particular bent, and they're trying to take a beautifully pure essence of a treasure that Nelson Nash brought to us, and they're trying to make bank on it. And the way I look at banking, private banking, the infinite banking concept is this is a way of thinking. This is a lifestyle. This is not something where you pick up this book and read through it and say, got it. And then you add it to what you're already doing. I'm repeating this theme very often that people often put put their finances into silos. And one silo is for retirement, one silo is for my kids' education, and one silo is for my mortgage, and one silo is for my emergency fund. And yeah, this is a great idea. This is a great product. This is a great strategy. And I'm going to add this strategy on to the other strategies I'm doing. And and very often people will say, as soon as I get X paid down, as soon as I get my second line of credit taken off my mortgage, as soon as I get my student loan paid off, as soon as my kids are out of the house, as soon as I do all these things, then I'm going to add this on. You're going to get a very weak result. And the challenge here is that we've been thinking about money in a certain way, however that way is, for a very, very long time, basically since we could read. And here Nelson Nash comes along and he says, Joe, do you know how money works? And at the time that he asked me the question, I said, Nelson, I think I do understand how money works. I've got some letters after my name. I've been in the business about 25 years, and I think I got it going on. And then Nelson starts to ask me, well, tell me, what's the relationship between banks and the government and Wall Street and the life insurance industry? And I staggered and stammered and stuttered and said, Nelson, I guess I don't know how money works. And this is after I attended the first seminar with Nelson Nash in about the year 2000, and it was a 10-hour seminar. It wasn't like these wimpy little 3-hour seminars that we do. This is Nelson Nash introducing the book, and we'd have 2 hours the night before, let's say on Thursday night, and then 8 hours on Friday, and people would walk out of there with their heads spinning and saying, "I didn't know how that worked. I didn't know anything about that. I didn't know rich people do this. I didn't know how simple it was. I didn't know that I could build wealth without risking my money in brokerage accounts. And why didn't I understand this sooner? And how come nobody else has brought this to my attention? Hey, Joe, how come you never told me about this? Well, because I didn't know about it either. I didn't know that there was such beauty and simplicity in the industry that I was already a part of, and even the insurance companies don't know how to apply these truths um, for our clients' benefits. So today is in essence a 3 hour, 50,000 foot view of this topic, and I encourage you to think about creating a blank slate, a blank sheet of paper, a blank screen, and starting over and questioning everything that you thought you knew about money, and determine in the mirror if it's actually working for you. And as before I hit the next button, I always have way too many slides and way too many concepts. Every single page could be a, a topic in itself, a conversation in itself. I want to say that these things are what we have accumulated in our minds that people worry about. These are the things that keep us up at night, or many of us up at night. It's all around. It's all around finance. If you disagree, put it in, put it in the chat, right? But this is what I found. If you're a high net worth person, if you're worth millions of dollars now, learning to think like a banker and like an entrepreneur and like an owner is probably a little bit of what you've already been doing. So we've been able to help high net worth people secure their wealth, make their wealth more efficient, because rich people want to be more efficient. They want to be more lazy. They want to be more hands off. They want to set their machine in place, and they want it to run for generations and generations and generations. So high net worth people, once they get this, they get it, and they start to implement it and expand the system for their kids, their employees, their companies, their charities. Now, let's say you're in the middle. You're in the majority of Americans. You're making decent money. You're taking care of your family. You're making your bills on time. You take a vacation, or maybe even two. You've got a couple of nice cars, and maybe you're having those dreams about a vacation home, right? We can help you to think more clearly about your money, about your wealth, about the leakage that you're experiencing, the hemorrhaging that you're experiencing in your budget. Because I'll say most people are wondering where's all that money going. I made such and such money last year. I made 75,000. I made 175,000. I made $400,000. And somehow at the end of the year, it seems to be mostly in somebody else's pocket. And you could, if you have your camera on, you could just nod or give me a thumbs up, or you could laugh, or you could do this if you say, Joe, you're full of it. Um, Most people agree with this impression. So people who are in the middle, the wage earners, the executives, the doctors, people who are making decent money but don't know where it's going, can improve their lives, improve their wealth picture, improve their forecast for the future. People who are not quite there yet, excuse me, people who are struggling, who are living paycheck to paycheck. So we have the high net worth can be helped. People in the middle can be helped. People who haven't been able to save $10,000 and don't have $10,000 in the bank can be helped, because this is an encouragement for you to start putting yourself first and putting your family first, and getting a realistic appraisal of those people out there, whoever they are, those institutions, those banks, those lenders, those toxic lenders, who at the end of the year have our money in their pockets. And one of the props um, that I will talk about in a minute is my little list of 500 banks. And when I was at the meeting in Delaware a couple of months ago, I laid this out across the room, and it went out about 35 feet. This is a list of 500 banks that have failed this year. I'm sorry, the century. Forgive me. Since about 2005, 500 banks in this country have failed. How many life insurance companies have failed? Zero. And we'll get into the long and short of that. So what keeps you up at night? These things. If you have another thing that keeps you up at night, put it in the chat. Let's list it out. Let's talk about it. I was kind of, being humorous with Yvonne right before we started today, and said, I could relate almost everything in life to economics. Everything in life has an economics um, angle to it. And what's economics? It's the management of our finances. It's the management of our money. It's deciding what comes in, having control, having choice over what comes in, how to manage the resources that we have, and how to distribute them according to what we want to do. So the question becomes, if these are the things that keep me up at night, and I make $50,000 a year or I make $500,000 a year, why are we all struggling as a people? Is the answer really more capital? I'm saying no. I'm saying it's not the amount that comes in. It's that we're not making the most educated choices with what comes in. And I love many of the things that Robert Kiyosaki says. And especially one of the things I like about him is that he is not a life insurance proponent. So I'm taking some wisdom from him because it has to do with money, purely a conversation about money. I'm saying this guy is not even a fan. I'm not using him as a ploy, as a shill and saying, well, he believes in life insurance, so you should. No, he talks about money. He talks about why poor people who are trying to get rich by saving are really kidding themselves, because you can't get rich by saving money in a savings account, because you're going to be slammed by everything that the banks are doing to us when we put money in the bank. So when he says most people are poor because they're seeking their financial advice from salespeople as opposed to rich people, they're not getting what's going to help them. What we're telling you today is what is going to help you. If you never see us again, if you never see again the person who invited you to this webinar, and you take the principles and you put them into play, thank you. If you put them into play and you execute, you will see results. And there is a difference. Am I saying that I'm a rich person? I tell you what, I have control of my finances. Since meeting Nelson Nash, I've turned my finances around. So I told you it's about 25 years since I met him, and 25 years in the business. So I'm about year 50 applying the principles that Nelson taught us. There is no other system, no other model, no other philosophy that's even come down the pike that anybody says is new. The majority of financial advisors out there, financial salesmen, are selling what's been sold for the past 100 years. So this is Nelson Nash, and I love talking about him. I love talking about his life, his approach to people. This little man, maybe 5'4", 5'5", standing up there in front of the classroom with a cup of coffee in his hand for 10 hours, teaching all of us about how money works, and talking to us about logic and imagination and prophecy. He says you finance everything you buy. Think about this. This is the change of our thinking. You finance everything you buy. It's easy to think of a car loan. Yeah, I financed the car with the dealership or the finance company, and I paid the interest that they charged me. Yes, that cost me the interest. Or if you do what the other financial entertainers say, is pay cash, you're giving up the interest that you would have earned. Number one. Number two, you're losing control of that capital. And so when somebody else says, well, you don't pay interest when you pay cash for something, that's really not true, is it? Because think about all the money that capital will produce for someone else once it leaves your system. I paid $30,000 cash for the car. That $30,000 is going to continue to grow indefinitely, in perpetuity. And we can calculate that. You can calculate that with any calculator you want. That $30,000 is going to grow. You finance everything you buy. What this model is all about is recapturing that capital so that you're borrowing from your family banking system that you control and you own and you manage, as opposed to giving your money away and trusting the people out there whose sole interest is getting your money. So when I was 18 years old, I had my own apartment and I was sent a offer of a credit card from Chase Bank in New York. And I said, wow, what a great idea. I got a $3,000 credit limit. I could go and party. And what's the idea? The idea is, let me see if my highlighter is going to work. Yeah. You start out in a hole, don't you? And you pay back those payments and you become a good citizen and they give you a great credit score and a great credit limit and they give you the opportunity to dig yourself a deeper hole. And you keep on making those payments and you're faithful. And at the end of your life, the creditor, the credit card company, the toxic creditor lender has all your money. So dad or grandpa would say, don't use credit, pay cash as you go. So instead of buying something on credit, you save up the money. You don't buy it then. You delay your gratification and you wait until you have the money and then you buy the thing that you want and you wind up getting back to zero, the same place where the borrower was. So we have a debtor and a saver winding up at the same place. The saver feels like he's making progress, but he's really not making any because he's not building up capital. He's building up capital for somebody else. There's a third option, which is what we're teaching. Become a wealth creator. You set up a capital account of some kind. Let's use a stock market account, a brokerage account. Many people like them. Many people don't like them. But when you use an asset like a stock market account, you can borrow against it using a margin loan. There are pros and cons. Is this better than nothing? It absolutely is better than nothing because you're building an asset that you're borrowing against. And against is an important word because you're building an asset that's going to grow, hopefully. Some years it won't, some years it will, but you're going to borrow against that asset and buy the other thing that you want. Now you've got two assets where the saver, the debtor only had one. They had somebody else's credit facility, somebody else's credit system. Using your house as collateral is something that most people are familiar with. You buy a house, you put a mortgage on it. You go down the road, your house grows in equity, you refinance, you borrow more money out. Now you've got more debt, or you take a second, and then you've got more debt. Your house continues to grow and appreciate. But the principle is if you're a wealth creator here, you're building up an asset and you borrow against it to build another asset. There are pros and cons to each. What we're suggesting is doing what many, many thousands of rich people, Fortune 500 companies, and banks themselves have done to build their wealth and to build their balance sheet and create wealth safely. And that's to own a life insurance policy, or in my case, a portfolio of life insurance policies, or in the bank's cases, a portfolio of millions and billions in life insurance. They don't tell us that they're doing that. Looking at it another way, I'm watching the time, Yvonne, because I know I'm going to go over because I always do. You collateralize real estate, an asset that can go up or down. You collateralize a brokerage account, just like on the previous screen. It could go up or down. You collateralize your future earnings by borrowing against it, by using a credit card, by taking a personal loan, by taking an SBA loan. You're borrowing against future earnings. Now, your future earnings may go up year by year, but your future earnings will come to a limit, will come to a stopping point. There'll be some point in your life at which you will stop earning. But in using a life insurance policy, you're using an asset that will continue to grow. And Nelson has taught us this, and we've learned over the years when you own a life insurance policy, you're starting a business in essence that has never existed before. And as it grows going forward, it will never lose value. I mean, that's important to understand. A life insurance policy will never use value. Do you wonder why rich companies and banks use it? Sorry, Yvonne.
No, no one, I didn't say
Okay,
anything.
sorry. All right.
A
Um,
life insurance company will never, or policy will never lose value.
we'll never go backwards.
Period. It will never go backwards.
Never go backwards. And that's a good point because in probably won't be able to get to a typical life insurance illustration or contract in the Q&A, but the person who invited you, the agent or advisor who invited you, will be able to show you those kinds of numbers. Once you set up a life insurance policy and you add to it and capitalize it year after year after year, you're building an asset, in essence, a savings account. It's like a bond. It's not identical to a bond, but it's like a bond. It's not like a stock. It will go up year after year after year. I've only owned policies for 50 years, so that's a very short window compared to the window of time that life insurance has existed, let's say 200 years. My policies have never decreased in value. Okay.
Oh,
I'll just keep on going because I couldn't hear the comment or question. Just a word about the debt clock. I mean, part of what I believe about what we're doing is we're doing social work among the rich or the wannabe rich, which is all of us, right? We want to control our wealth. We want to become wealthy, and you can fill in your own reason why. I want to be wealthy so I can take care of my kids. I want to be wealthy so I can take care of my wife throughout her lifetime, not just my lifetime. I want to be wealthy so that I can support the causes that I believe in. And what they're doing with our monetary system and unfortunately every monetary system in every country is governments are borrowing against our future and our grandkids' future and our great grandkids' futures. And right now, you can't see that if you look at the national debt, the number that they always point to, the $36 trillion, is not the biggest problem. The biggest problem is the total debt, is the unfunded liabilities of not only the money that we owe, but the future pensions of retired workers, retired government workers, retired military, retired workers of any kind, state and federal, over 100 trillion that we owe. Aside from that, you should be talking to your congressmen, your senators, and getting them to balance our budget so that we as a government will stop spending more than we take in. Is the government following the family or is the family following the government? Because both are overspending. Both are spending more than they bring in. This is a conversation that's very important to have, and I can't spend a lot of time on it. Most of your money is resting in one of these first two buckets, red or green. The savings account earns very little, but it is taxable in the current year. Your earnings are taxable in the current year. When you put money into a deferred account, you don't know what the taxes are going to be in the future. You don't know what you're going to earn in that 401k. And where wealthy people are learning to store their money is in the third bucket, the tax-free bucket, the tax invisible bucket. Roth IRAs have a very low, very strict limit on what you can put in and restrictions on how you can access the money. Municipal bonds are only for the particular state in which you live, and they could still be added to certain calculations when you file your taxes. Cash value life insurance is the best kept secret among rich people. Banks don't want you to know about it because they own billions and billions of dollars worth of life insurance, but they don't want you to discover that you can do that without going through the bank. Because when the bank buys a life insurance policy, it's not benefiting you. Nelson asked me, he asked the clients all the time, do you know how banks work? It's important to understand how banks work because an insurance company is a bank. A commercial bank down the street is a bank. The credit union is a bank. I
Um,
just watched this
John, sorry,
YouTube.
we have one quick question regarding the
Sure, please.
were those two separate debts, or does the 103 trillion include the 36 trillion?
Yeah, it includes the 36 trillion, and then 100 trillion was the wrong number I pointed to. It was really a number that was larger than that. It's close to 200 trillion dollars in unfunded liabilities. So we don't have the money to pay all the pensions of all the retired people. I mean, I spent 45 years in Las Vegas, Nevada. Nevada is tens of billions, as one of the smallest states by population in the union. Nevada is tens of billions of dollars in the hole. They're paying police, fire, first responders, government workers hundreds of thousands of dollars per year because their pension is so rich. They've promised to pay them money that they do not have in the bank today, and they can only hope that they're going to make extra money in the stock market so they can cover the future payments that they have to make. What do they do in the meantime? They raise our taxes. Where do pensions come from? Where does government expenditure come from? It comes from taxes. That study of the U.S. debt clock is another study in and of itself. Just Google usdebtclock.org and start to understand all those different windows, 100 of them, to find out where the money's coming in, how it's going out, and in some places, how our money's being mismanaged. This is our money. What you see on the screen is an example of that. Josh Hawley, a senator from Missouri, I think, had Visa MasterCard on the hot seat. And he asked them, so what is your profit margin? And they said about 50%. And how much do credit card owners, credit card users owe to you today? And they said, well, we would have to look up. And he said, don't worry about it. I've got the chart right here. He told them, you have accounts receivable of $1.17 trillion. Credit card users owe you $1 trillion. What's your profit margin? About 29%. Now, nobody has a gun to your head, folks, right? This is $1 trillion that we've decided to borrow over and above what we're already earning. We're not earning enough. Doesn't matter how much you make. We're not earning enough. We need to spend some more. So we put on a credit card. These are only two credit cards. There are probably hundreds. That's $338 billion that's going to Visa, MasterCard every year. Talk about an annuity. That's their net profit. What is that? $1,000 per American per year? That we're just sending to Visa and MasterCard so that they can allow us to live a higher lifestyle than we've earned. And the number doesn't matter. It's not like, well, if I make $150,000, that's a magic number. No. Everybody is in the same place unless they've learned to control this. You read Nelson's book and you'll read about the human conditions, the human problems. Parkinson's law. 90% of Americans, 95% of Americans are spending more than they make. That's Parkinson's law. A luxury once enjoyed becomes a necessity. I'm thinking about the heated steering wheel on my truck. Bank of America, and we'll go more quickly. Bank of America, I use as a typical example because they're one of the big three. We make deposits as savers into a bank, and then the bank turns around, repackages the money that we put in, marks it up, and lends it back to us. You have to understand, banks don't have any money of their own. At the time in which I got this information, 7, 8 years ago, and the numbers keep on going up, Bank of America had $900 billion on deposit. They have to pay us something. They paid us 0.3% in interest, which was by the way, taxable to us. And in return, we paid them $50 billion. We paid them 16 times what they paid us. This is our money. Why did we pay them $50 billion? So they could repackage it into a loan. And of course, maybe you only had $20,000 in the bank, but you were borrowing 100,000. You're borrowing $200,000. You're taking an SBA loan. You're taking a business loan. So people would say, well, a bank's got to make money. They have to make a profit. They're in business to make a profit. Exactly. But they're making 5.5%. We're making a third of a percent. The ratio is 16 to 1. They're making $16 for every dollar we make. And that's not all that they do. They're using FDIC, which we can't go deeply into. They're using velocity of money, keeping it in motion. They're using bank-owned life insurance to make profits for themselves, not for us. What's the alternative? The ideal savings tool. And this is our hypothetical. You can argue with it. You can give me a counterpoint. You can say, well, there are other alternatives. Absolutely, there are other alternatives. We're not saying that using a life insurance policy or portfolio policies is the only way to build wealth. What we're saying is this is part of the wealth strategy of most wealthy Americans, and we'll touch on it later. J.C. Penney, Walt Disney, Doris Christopher have taken loans against their life insurance to build their kingdoms. The ideal savings tool would have all of these components. You want to have guarantees. You want to be credit protected. You want to be tax free. Most people who are at the paycheck to paycheck level are not thinking about this because they don't have any money put away. The first thing that you have to do to become a wealth creator is to start to save until it hurts. So the ideal savings tool. How does the 401k match up with these 6 components? Well, the 401k, you don't get guarantees. You don't get uninterrupted compound. You don't get liquidity. You have a lot of limitations and a lot of uncertainty in a 401k. You get a couple of things. What about an ordinary savings account? You don't get a competitive rate of return. You're not credit protected. Somebody sues you, wins a suit against you. They can go to your bank and pull your money before you even know it. With a specially designed life insurance contract, and I say specially designed because different practitioners will design policies differently. I discovered when I met Nelson 24 years ago, 25 years ago, that I could actually reduce or shrink the fees that are built into a policy that I sell to a client. I could reduce those fees by over half, increase the client's access to capital, increase the client's equity, and still make a good living and help my clients even more so than I helped them before. And this tool checks all these boxes. Can you do it differently? Absolutely. I could put gold in the middle of this slide. It'll work. Will it be cumbersome? Absolutely. Will it be clunky? Yeah, absolutely. Will it have guaranteed increase in value? Of course not. What I'm saying is you can do private banking with any commodity or any financial vehicle that you can come up with. It will be sloppy. It won't have these benefits, and it won't follow the track record of all the people who have built wealth doing it this way. And we won't go into all the details. I'm just going to um, fly them onto the screen here, and please get with your advisor that brought you here today and ask them for the details of every single one of these components, all pertaining to life insurance. I think that the last one I'm going to leave you with, generational wealth and then unlimited contributions. That's really important. I can control. I don't have to be told that I can only put $6,000 to a Roth IRA. I can only put $25,000 into a 401k and lose all these other benefits, access, and so forth. But the last thing that I'm going to list here is private. I love the fact that I can build wealth that's private, that's not visible on my tax return, that the government is not going to see growth in my accounts from year to year because my insurance company is not sending me a 1099. They're not sending me a statement that says you've got to pay so much tax on your growth for this account. So we're suggesting become a wealth creator. Here's a simple conversation. Would you buy this business? Let's say that you were to capitalize and don't let the numbers make you crazy because some people look at this chart, they say $30,000, that's impossible. Then move the decimal, make it 3,000. I had a dentist who came in one day and he said, that's all I can put in. I said, no, move the decimal, make it 300,000. He said, okay, now you have my attention. It's all relative. It all works the same way. Poor people, smaller savers, don't get an inferior product that a high net worth person gets. It's the same product. We're just moving the decimals. Let's say that you added $30,000 to a brand new business and you got $18,000 in cash flow in year number one. People who are not business owners might say, that's not a good deal. I lost money. No, the truth is, when you start a new business, you put in $30,000, you're going to lose $30,000 in the first year. You're not going to make a profit at all. From the business aspect, from the cash flow aspect, we're talking about a business that starts cash flowing in year number one because you're getting a very considerable amount of cash flow in year number one. Year number two, almost 100%. In year number three, almost 100%. In year number four, you're cash flowing more than you put in. As you go down, as we referenced earlier, a life insurance policy is a vehicle, a financial vehicle that never loses traction. This is just a little bit more detail. We can review this with you again on a one-on-one. Um, the thing is, you don't want to get to the what before you understand the why. Do I want to get control of my finances? Do I want to find out in black and white, in numbers, in dollars and cents, why I'm losing money? Where am I hemorrhaging money? Let's find out what the problem is first. Let's find out whether you feel that becoming your own banker makes sense in the aggregate. I'm not talking about becoming your own banker for 10% of your money. I'm talking about becoming your own banker for all the money you're ever going to earn, which is going to be in the millions. Here's a very brief listing of just the top banks. Bank of America, the one that I spoke about a minute ago, has $24 billion in equity, cash value of life insurance sitting on its balance sheets to protect and to save, to serve whom? Not us. It's supporting their pension. Bank of America has more cash value of life insurance than they have equity in all their real estate in the country. As I mentioned, these are just a few examples of business owners, wealth creators, who started out by taking loans against their life insurance policies. How are we doing, Yvonne? I'm at 11:44. That's amazing.
You have 6 minutes. Yeah, you're ahead of the game, and that never happens. So we can certainly take questions if there's anything else that people want to review. Any comments, you can unmute yourselves, and we want this to be interactive and certainly more of a discussion than a presentation. So feel free to ask any questions that you may have.
How do we get started?
Great.
Good question.
Great question. You contact the agent who invited you, and I hope you will have read the book. And before you make that call, I'd suggest that you read the book at least twice. Just whip through it, read through it quickly. Don't read the book at 10 o'clock at night because you'll lose sleep. And then go back a second time, with a pen, make notes in the margins, write down questions, write down question marks when you don't understand something, where it goes against what you thought was true about money. Somebody said, if you if something that you believe to be true turned out not to be true, when would you want to find out? Well, I wanted to find out now when I learned about this. And I was supposedly an insider, a financial professional, helping hundreds, probably thousands of clients the first 25 years. The thing that happened to me by God's grace, you can say by accident, was I was using what I call the correct product for the first 25 years. I wasn't structuring it as efficiently as I could have. All I learned how to do, among many things, when I met Nelson, was learn how to structure a policy so clients could access equity sooner and encourage clients to put massive amounts of cash in their policies because there's no opportunity for loss. And you could turn around and use this program to recapture and knock out all the debt in your life. I mean, I've had a doctor client pay off his $1.3 million residential mortgage in less than 7 years. We watched him do it from day one. He was 66 years old when he started his program. He paid off his $1 million mortgage in 7 years. He's about 80 years old now. His policy is flush with cash. He had two assets. He transferred his ordinary mortgage from his mortgage company to his policy. He built up the policy, paid down the mortgage to zero, and then he paid his policy, which was a much more efficient financial tool. And today, he has a house that's paid for, worth over $1 million, and a life insurance policy that's, you could say it's paid for, it's cash flowing, it's worth almost $1 million. He built two assets. How do you do it? Get with your agent.
Yeah,
Am
we
I
There's a
like.
going to
question in the chat.
am I going to go into the car example now, Yvonne?
No,
In a
not
couple,
yet. No. So if you can stop sharing, then I'll share mine. There's one last question,
I
Joe,
will.
before I get
Sure,
started.
please.
And the next section that we're going to talk about is going to be actually the policy design, right? We want to show you how the vehicle works and how we structure it so that you can get an idea. But there's one last question. What's the significance of reading the book? Why not just get started before reading? Is the question here, Joe.
Great question. I have a great client who's been with me about 25 years. He's an MD radiologist, and he said to me, I'm not going to read your stinking book. He said, I went to medical school, took me 12 years to become the doctor that I am, and I don't have time or interest, but I trust you. Listen, if you trust us, if you trust the agent, that's going to be important. If you don't read the book, it's going to be uphill because every so often you're going to have questions. And then one of us is going to say, did you read page 45 of the book? Let me show you how it works. Let me show you on page 45 how the two sisters, one used her bank account, her CD, and one used a life insurance policy to fund a car or multiple cars. And the sister who had the life insurance policy wound up with hundreds of thousands of dollars more money, and the car is paid for. So if you don't read the book, you're not going to get the foundation. You're not going to get the essence. And it's up to your agent as to how they're going to communicate all this wisdom to you, because it's not just for you, it's for the people around you, it's for the people that you love, it's for your next generation. And it'll be crystal clear once you read the book once, twice, 10 times. I encourage our agents at Alpha Mega Wealth to read this book every single month in full. So there's so much wisdom and knowledge, and maybe to you new information that you didn't understand was actually historically correct. You'll get so much more out of the book.
Yeah, and in the chat, thank you, Ashley. She's sharing the link to be able to find the book on Amazon. There's also Audible. It's available. So anyone, and we'll have a QR code at the end of the presentation also where you can click and you can link into. Before I get into the actual vehicle, any last questions for Joe? He'll be back to close. The next of the presentation will be me talking about the vehicle. Then we have Jason Powers and Mike Stevens are going to show some examples on how to use your banking system for debt reduction, for purchasing real estate. So, it's the why you want to become your own banker, how do you structure it, and then how do we use it? And that's what we want to accomplish today. So I'm going to get started with saying that the vehicle, right? You can use any vehicle to create a banking system. You can open a checking account, you can borrow the money, you can repay it back yourself with interest, right? The vehicle is whatever. What I want you to think about as you're thinking about doing this is your behavior. We can set up as many policies, we can set up as many programs, but if you don't do what you say you're going to do, if you don't put the money, if you don't restructure your finances to be able to accommodate and to understand the bigger picture, doesn't matter how many vehicles we show you or how many things we show you, right? You control this equation. You control how much you put in. You control when you put it in. You control how you take the money out, how you utilize it to get other cash flowing assets. You have total control of how this is. All that we're helping you with is how to set it up. But at the end of the day, you must. And a lot of people say to me, what's the biggest failure of the system? The person. The life insurance will always be there, is accommodating the dollars, is remembering to pay yourself first, is remembering that every dollar that comes into your system has to be put through your banking system. And I know that all the advisors here share the same sentiment that I do. That's when our work begins, right? Our work begins when you set up your policies and we help you manage them, because it's so easy to revert back to the old ways. It's so easy to go out and spend all this money and forget that you need to pay yourself back. Okay, so let's talk about the life insurance contract that we talked about. And the first thing that I want to kind of do is a quick little class on the different types of life insurance. Many of you have heard of term, you've heard about whole life, you've heard about universal, you've heard about variable. And I want to make a distinction about a death benefit life insurance versus the cash accumulation life insurance, right? All of us have a human life value. All of us are worth financially something to our families, to our loved ones. And that human life value needs to be protected, because above all, if anything were to happen, and by the way, it's not an if, it's in when, right? And Joe calls it graduating. We graduate from this earth. There will be a death benefit component that will be passed on to your next generation. So to me, most important of all is a generational wealth tool. It's a way for me to pass down a wealth. And you have to not only think of it as a banking system, but think about, right, what's the legacy that you're going to leave behind? What are these dollars going to do for your family? So as you're looking at life insurance, we have term. That's like renting an apartment, right? That builds zero value. A lot of people hear the words buy term, invest the difference. People talk about cheap life insurance, and term has a place in your portfolio, right? If you have some kind of a loan, there's a lot of business owners that have loans, and the banks require you to have some kind of a life policy to cover that loan in case something happens. So there's a space for term, but terms build zero value. Therefore, if all you own is term, you're basically hoping that, well, not hoping, you think that something's going to happen in that period of time where you're paying that cheap premium. So term is not the solution that we use. What we use in order to create these policies is a whole life contract. And we're going to kind of dive in, and I'm going to give you a little class on how life insurance or how whole life contracts work. The first thing that you have to remember or you have to know is the company that you're going to purchase your life insurance from. That is probably one of the most important things for you to, as you're researching this, because there's two types of companies. You have a stock versus a mutual company. A stock company is a company that is owned by the shareholders rather than the policyholders, versus a mutual company that's a company that is owned by the policyholders. So we only utilize mutual companies to create your banking systems. These policies must be from a mutual company because you must have capital, a stake into the profitability. I can't even say that word, Steve. I'm all Puerto Rican out here, for that company. What I'm trying to say is that every single time that you create a banking policy, every time that you put money into these policies, you are an owner of that company, and you're going to share in the dividends that are going to be given not guaranteed, but given by the companies at the end of the year. So that's a very, very important factor as to where do you begin to build these policies. Okay. So we utilize mutual companies. Also, and kind of this kind of gives you a little bit about the difference between the two. And I went through it. To me, one of the most important things is in a in a stock company, if you look at the stock dividend that are taxable versus the policy dividends non-taxable into a mutual company, that's very important. And it's important because you're creating a tax invisible, a private, like Joe talked about, something that's non-reportable. You want to keep all of those items, right, in the right vehicle to make sure that you take advantage of all of the things that come with creating this private banking system. Let's talk about the specially designed insurance contract. You want to make sure that it's designed for the living benefits available to the policy owner. And we're going to talk about what that means here in a moment. But a lot of people think, oh my God, a life insurance contract, it only pays if I die. There are a multitude of benefits that come with owning these policies, managing these policies that you can utilize while you are living. Number two, you must use it as a financial instrument. You must see it as a financial instrument, as part of, and in a way, and I tell my clients, and I think when I train my agents is, you're building almost like a franchise. Every policy that you purchase, every policy that you structure, is like Joe showed, is starting a little business. Is starting a new equity bucket where you're going to utilize for whatever it is that you're looking to use for. It must be a cash flow system. There must be liquidity. You must be able to design this so that every time you put a dollar in, you have the ability to reuse that dollar over and over. It has to be a warehouse for wealth. Any influx of money, you have to have enough policies put together so that when you receive a windfall, when you have additional income, you have places to put it in. The policy's cash value serving as collateral, right? And this has to do with using other people's money, like Bank of America does. Bank of America uses our money and lends us our own money that we deposit. You want to use someone else's money. We're going to talk about how we use the loans and so on and so forth as collateral. And then legal right is provided to all policy owners, and we'll kind of discuss that a little bit. So I'm going to start talking about not just how a contract works, and I'm going to show you how a normal whole life policy out there works, but it has to be, it cannot be a minimally funded policy, right? You only get minimal levels of benefit if you only put a small amount, right? You have to figure out a way on how you're going to create a system that is going to be able to flow enough dollars in order to create the system and the cash value that you are going to want to generate to go do whatever it is, whether it's college funding, whether it is debt reduction, whether it's purchasing real estate. Okay. And let's talk about how we put that together. One of the things that we want to talk about is the idea of the funding of the policy. And what I mean by that is that let's say that you're going to buy a life insurance policy of $500,000. And I'm just using this as an example. There's going to be a minimum premium and a maximum premium that you're going to be able to pay for that same amount of the death benefit. And that it's called the corridor, right? The corridor is the amount of money that you're allowed to put inside of a contract from the minimum to the maximum beside until you hit a certain maximum number. And that maximum number is controlled by whom? Oh my God, surprise, surprise, the government, right? The government puts a limit on how much money you can add to a certain policy before it becomes what? A taxable event for that growth. So you want to be able, and it's interesting because the fact that the federal government wants to limit that, what does that tell you? It's going to be a good for tax, right? Invisibility inside of that corridor. So we're going to, first of all, build the policy in the corridor. And when we look at the corridor, and by the way, the government contract that limits how much you put in, right, came in the 1980s from two different laws that were done in 1984 and 1988, right? Prior to those laws, there was no limit on how much money you can put into these insurance contracts. But the government comes in and says, hey, right? And by the way, they're continuously are looking into how they're going to come in and how they're going to do and how they can get inside of these policies to tax them, right? So at the end of the day, we want to make sure that the policies do not become a modified endowment contract. That is what it's called. It's called a MEC limit. And we are going to put enough money into our policies that go right up to that line. If it exceeds that line, then we go into the situation where it becomes kind of like a qualified plan, laws come in. So we never want to put too much money into any one particular policy. And that's why you're going to create, and you're going to see us talk about, and you're going to see Mr. Nash talk about creating a system of policies that you build throughout the years. And I'm going to talk about how the players of the policy are put together and how that looks. But you want to make sure that, for example, let's assume that you could pay between $1,000 and $10,000 for that $500,000 of death benefit that I was talking about. The most people would say, well, I'll pay the $1,000 because they're purchasing a product. Most people will say that's a term policy, right? The least amount of money that I'm going to put in for the most amount of death benefit. On an IBC policy, on an infinite product design, you are going to think the opposite of that. You're going to want to see what is the maximum amount that I'm able to put all the way up to that MEC limit in order to maximize every single one of the benefits of that contract. So our IBC policies are designed to maximize, to get closest to that MEC limit, not to minimize the cost. Okay. And I'm gonna kind of go a little bit more deeper into that. But it's really, really important for you to understand that this is going to be developed based on you. You tell us what your funding is. You tell us how you would like to structure this, and then we'll build it backwards. It's not about the death benefit, right? It's about accommodating the deposits, and I call it a deposit. I don't call it a premium payment. It's not a bill. This is a system where you're going to flow your dollars through, and every single month, every single year, you're going to be, I apologize, every single year, you're going to be able to decide how much money you're going to flow through your system, right? So when we look at IBC capitalization, when we look about how am I going to maximize this contract, we're going to want to take advantage of all of the things that you see on the right side, the tax deferred growth, the tax redistribution. You're going to have the collateral opportunities. And listen to me, I am 57 years old. Not that I want to date myself, but to me, long-term care has also become a very real thought lately, right? I'm a single mom of two kids, and the question is who's going to take care of me? These policies also carry a living needs benefit. That if I were to become ill or I were to have some kind of a long-term care need, I can use some of that death benefit while I'm alive to pay for the cost of that care. So the banking system not only is going to create that for me, it's also going to give me some long-term care protection in case that I need it while I'm alive. Okay. And you have to make your banking policies as efficient as possible. The goal here is not to put the least amount of money. That's the purchasing something, right? It's about how much money can I stuff and how can I design it so that I get the maximum amount of cash accumulation that I need to be able to use that money in order to do whatever it is that you're going to purchase it with. And I'm going to show you about the design. Any questions at all so far? I know that this is, and I try to be as simple as I can with this actual, there's a lot of internal pieces that go inside of those contracts. I will tell you this. Um, what was that movie? I forget the movie, but it says if you build it, they will come, right? If you commit to funding a policy to its maximum level, it will never fail you. If anything, it will become better and better. Dividends will continue to get paid from the life insurance component. Cash value will continue to have uninterrupted compounding, right? It will continue to go there. Yes, Steve.
I'm sorry. Go ahead and finish that thought, but there's a question in the chat that I want you to answer.
Oh, okay. What we're saying is that the building process of the policy is the most important factor. And in the first few years, it's not going to look that exciting, right? It's not going to be like, oh my God, I made it 50. No, what it's going to look like, it's going to look like you are toggling along, right? But the consistency of adding the dollars will continue to grow the banking system. Yes, Steve.
All right. Well, Starla had a question in the chat. She says, I am age 74 and I sold my house and have about $60,000 that I moved into a Charles Schwab account. Am I at a disadvantage due to my age? I listened to the book on Audible, but the pages didn't match the audio. I'm concerned about needing home care later, even though I'm in excellent health now.
Okay. And the question is, are you at a disadvantage having the money in a brokerage account? Is that what I'm sorry, Steve, I don't see the question.
Am I at a disadvantage due to my age?
For the banking system, the unfortunate part about the death benefit component is the cost of the life insurance is based on an age, right? And is that cost going to be so high? One of the things that I tell, especially in your situation, is whoever invited you here, make an appointment and let us look at all of the components. Before I can answer whether you're an advantage or not, I would have to look and see where it is invested now. I would have to see if you currently have any policies that that you may have that we can help you manage better. Because that's another thing, you guys. We're not here in the business of replacing perfectly well-placed policies, but we're here in the business, if you already have an existing policy, then and Giorgio said, my oldest client to start a policy was 83, right? There is not an age limit to start. And Joy, if you want to jump in and talk about it, there's really not an age limit. The most important part is, are you insurable, right? Are you healthy enough to get into the contract? And then we can manage how it gets funded. But I would recommend that you meet with your advisor that invited you here and let us work some numbers for you individually so that we can really give you the best advice.
Yeah, and Starla, we're gonna see you today at 1 o'clock, so we'll talk more about this too.
Oh, you're ready, Star. You're ready. I think that I'm on that meeting, right? With you guys? Perfect.
Yes, ma'am.
We'll look at your situation as soon as, when we meet today. Any other, for the advisors that are here, anything else that you wanted to add to before I get into the policy design, or any other questions? Are we all good? Let's talk about policy design, because I think that, a lot of people, again, I'm sure many of you have met with another advisor at some point. And the first thing that I want to kind of make sure that you start thinking about are the players of a policy. And the players are so very important to make sure that we understand how we're going to set this up, because depending on how we use the players, we can design different policies, right? And every single policy starts with the insured. The insured is the person whose life you put the policy on. So you could be yourself, it can be a spouse, it can be a child, it can be a parent, it can be a business partner. Any of those people it has to be a human being, right? To be able to be the insured. But it is the owner of a policy, who controls the actual policy itself. So for example, I own a policy on my daughter. It's her life, but I am the owner. Therefore, I have control over money coming in, money coming out. You can be the owner of a policy in your parents. You can be an owner of the policy in your business partner. You can be the owner of a policy on, a trust account, right? Like your trust owns a policy on you. There's the owner. The owner can be any given entity that has some insurable interest on that insured. The payer can also be a different player, right? You can be yourself, it could be a business, it can be a trust that pays the premium. So you can have a payer be a spouse, for example. A spouse owns a policy on the wife, or vice versa, right? And then the last player is the beneficiary. So when you meet with your advisors and we're designing these policies for you, we're going to talk about this. Is this a business-owned policy? Is this going to be a personally owned policy? We have clients, Joe and I have a client that's a contractor here, right? And Jason, I think you said something, yes, but there are a lot of variables. Do you want to expand on that?
Where what?
I think that you said something here, Jess, but there are a lot of variables. Did I miss a question there?
No, I was just answering a question.
Oh, okay.
Here. Yeah, it's okay.
Oh, okay. So one of the first things that we're going to talk about is, who are the players? Is this going to be sometimes, Joe and I have clients that have individual policies that are individually owned and policies owned by the business for different reasons, buy-sell agreements, for business continuation, for deferred compensation, right? Or an individual business. Maybe you have a policy on your children for college funding. So we will be talking about this as you meet with your advisors as to how we're going to set them up. Okay. Let's talk about how we're going to build it. So a traditional whole life policy that most agents out there sell you as a product is 100% on the death benefit. So somebody's going to come to you and said, if you want to buy $500,000 of death benefit, here's the amount of money that it will cost you, right? 100% of the money goes for the cost of the death benefit. On a IBC policy, we do a blend. We utilize something called a paid up additions rider, and that will allow us to minimize the cost of the death benefit and maximize the cash accumulation component of the policy. And as you read the book, Mr. Nash will, also show you the same concept. And let me show it to you in numbers so that you understand. Here is a 40-year-old female with an initial premium of $10,000. Remember when I show you the corridor, right? You can put the maximum of 10,000 all the way up to the MEC line. You can do the minimum. We're going to create this policy to show, and I did it on a 60-40 blend. So I'm going to put $4,000 towards the base premium. That's the death benefit component, right? And then I'm going to use $6,000 in order to accommodate the PUA rider. And I want you to see this cash value increase as you're depositing. This is exactly the same thing that Joe showed on his screen when he showed up, would you buy this business, right? You deposit the money, the cash value increases immediately once you deposit the money in. And you will see through the year, right? I put in $10,000 year 2, my policy grows by $9,634. I put $10,000 year 3, my policy increases by $9,500. Now what happens in year 4? In year 4, now my policy is called cash flowing. Now I put in the same 10,000, but now my policy is increasing by 10,138 and increases every year thereafter. This is where we want to get your policies to become cash flowing as quickly as possible, to become as efficient as we possibly can without going over that MEC line. And when you meet with your individual advisors that invited you here, this is what they will work with you. We will look at your numbers. We will look at an actual illustration that's going to match your needs. Not any two policies will look the same, right? We have to figure out what's your rating. What do you qualify for from the insurance company for the death benefit, right? You have to go through an underwriting process, make sure that you can qualify from a health standpoint. Once that's in place, then we build it, and we build it from whatever funding you want. Okay. Now, before I get into this discussion, because one of the things that has happened through the years, and it's like everything, you take something good and people will try to find a way to model it. People will always try to find a way to make it so that it becomes, I don't know, more profitable for the agent, I guess. But there's been a big, big surge in the last few years of people educating, podcasting, advertising, using IBC by utilizing an index universal life policy, right? They're promoting these policies as being permanent. And I'm not going to say that they're not, but there's a big if there, right? An index universal life contract is a blend, right, between a term and kind of like a whole life in a way, but is dependent on market risk. An index universal life contract is sold, and it's being told out there in the streets as, low premiums. You don't have, you can lower the amount that you put in the first few years. I'm going to tell you this. The killer of any banking system is not maximum funding. If you come across an agent that's trying to talk to you about, oh my gosh, we utilize an index universal life, I can show you an illustration that's going to really, really appear as if your banking system will be much greater. And I'm going to compare the two, because there's a lot of noise out there between using a whole life and this index universal life that I see advertised all over the place. As a matter of fact, I was watching TikTok yesterday and there was a whole live class going on using an IUL for banking. And I was like, this is exactly what we don't need. And let me show you why. I have a client who came in with a policy that they had already purchased, an IBC policy from another advisor, that they utilized an index universal life. And I compared that same policy with our whole life contract. I did the exact same funding, and I know the numbers may be a little bit difficult to see, but the funding was $9,530. The right illustration, which is the index universal life illustration, which he provided from his contract, shows me what the 10th year cash value will be after putting 95,340 cents into his contract. And that cash value would have been 48,943. On the exact same scenario, under the way we design our policies, you will see that 95,300 was also deposited into the whole life, but the cash value accumulation is 93,473. I ask you, which would you rather have? How is this index universal life a better option than my whole life, right? To me, numbers don't lie. Now let's look at the 20th year. After 20 years, he had put in the same 190,000 deposit into this banking system. On the whole life side, the cash value accumulation was 214,000. On the index universal life, it was 79,738. Be very, very careful to not educate yourself and understand the correct vehicle and the correct policy. Because when you look at the 30th year and you look at $276,000 being put into the system and only having, and the whole life having 351 versus ending up with 51. And by the way, the policy lapses at age 80. And it lapses because a index universal life, if you don't put enough dollars at the beginning of the policy, it self-implodes. The amount of fees and the amount of charges that are internally taking away dollars, it's overwhelming. So don't ever fall trap into, hey, this other advisor told me that an index universal life was a better option. Any questions about this, or any of the advisors have any comments, Steve, or anyone else that wants to jump in onto this bandwagon?
And the costs of, life insurance in an index universal life, we don't know what the life insurance company is going to charge in the future.
That's correct. Oh, thank you, Ursula. That's correct.
Mhm.
Right? They call it a permanent policy, but it's not permanent because there is a possibility of premiums. There's a possibility of premiums going up. There's a possibility of it destroying itself, right? When you're creating a banking system, you need guarantees. You need to know exactly the amount of money that's going to happen. If I do this, the only person that can kill a whole life properly structured contract is the depositor. Is you not putting the dollars in. But if you do what we tell you to do and you commit to putting the money in and you commit to doing what you have to do, the policy will only get better through the years. It only gets better. Questions about that? I'm going
Yvonne, the IULs, those are, or maybe it's only some, but are all of them annual renewable? Isn't it that the insurance goes up because each year it's like an annual renewable term?
Yeah, because it's kind of a blend. Exactly. The way that they keep the cost down is by by putting this internal renewable term, but that's what eats, the contract away. And I'm not saying there's not a place or a reason to purchase an IUL contract, right? Has to do with insurability, with age. What I'm saying is to design a properly structured banking policy. That's not the right vehicle. You want to make sure that it is a dividend paying, guaranteed whole life contract from a mutual company. That's the right product. That's the right vehicle. And now, any other questions about, and by the way, when you meet with your advisors, this is what they will go through, right? They're going to go through and run these illustrations for you once you go through the underwriting, because that's another thing, you guys. You can't purchase a life insurance policy. You have to qualify for it. And therefore, you have to go through underwriting. You have to go and see what the insurance company offer is based on the cost of that insurance so that we know how we're going to structure it. Without knowing your actual rating, is very difficult for us to show you any numbers. So while you're studying, while you're learning, go through your underwriting process and figure out what your rating would be so that then we can go ahead and put those policies together. Any questions?
Yvonne,
Yes.
I'll share just to give a real life scenario on which you just explained in terms of the the whole life versus the IUL and talking about the guarantee. Um, just in my former profession of being overseas and being paid over there, there's a lot of players and people who took money, for example, in euros, because at that time, this is like 2005, 6, the euro was stronger than the dollar. So they would take, hey, I want to be paid in euros. I personally was averse to that because the euro fluctuated. So yeah, there's months where you're like, okay, oh, I had more. But then when the euro fluctuates, now there's months you could have had less. Now, I didn't get the more, but I never lost either because I wanted my dollars because I know exactly what it was every time. If it was $10,000 each month, I'm getting $10,000 each month, no matter what. So that was part of the guarantee, you know.
Yeah. No,
So I'm like,
that's a perfect example. No, exactly. And part of the process of educating yourselves and part of the process of building this is working with your advisors that invited you here in understanding how these policies work, how they move, looking at illustrations. We're gonna each and every one of you will have an individualized illustration and situation that your advisors will build with you. Now, I want what and that's all great. So you build these policies, you do everything, but now we need to use the actual policy, right? And Jason's going to talk about debt management. He has a case study on someone recapturing credit card debt. After him, Mike Stevens is going to come in and talk about how to purchase real estate using your banking system. Because one of the things is the reason to build a system, right, is for the money not to sit there. You got to keep the money in motion, right? Velocity. The money has to move. And and in order to do that, you have to learn how to build the policy, but also how to use the policy. And how does that look like? So I'm going to stop sharing, Jason. If you want to, hold on a second. You could share your screen with your presentation.
Okay.
You should be able to share it just fine.
All right. Everybody hear me okay? See me okay? See the
Yes.
screen?
Yes, sir.
Okay. So I'm going to dive into this case study. I kind of in all case studies we look at, I want you guys to keep in mind, I think don't get caught up on the number of zeros that we're showing you. You know, we may give you dollar amounts that you're like, oh my gosh, that's a dollar I can never afford, or you may go, oh really, that's it, that's all I can do. So don't get caught up on the number of zeros. We will help design something for you and your situation. And everybody's situation is different, right? So you'll see 1,001 different examples. If you keep looking, you know, there's just a lot of ways to slice this. So one application that comes up often is people who have debt. And so the discussion then becomes, we want to look at what's the situation, you know, what kind of debt do you have, bad debt, good debt, how do we parse that out? And can we do something about this by changing the flow of our money? See, typically our money goes from income, we put it in our bank account, and then we distribute it out, right? We pay our bills, we pay our debts, and we spend what's left if we're not careful, right? Burning a hole in our pocket. So this client, when we first met, we were having a conversation. He really wanted to get into IBC, but we had a big number. I'm going to pull this off here. We had a really big number to deal with. He had credit cards, personal lines of credit, school loans, and had racked up about $109,000 in bad debt. He was spending a little over $2,000 a month in debt payments alone. And so we did the math, and you could see it was going to take him 30 years to pay it off, literally. Now, barring you didn't have an influx of income and start paying it down faster by some means. But the current trajectory he was on is going to take him 30 years, literally, to pay it off. So he wanted to see how he could do this. So we needed to come up with an overall strategy, right? We needed to kickstart a policy. We need to free up funds. We need to, what I just mentioned, change the flow of the money. How can we change the flow of the money? We'll talk about snowballing debt payments. We want to create cash value, decrease debt, and build your own private family banking system. So that's what we set out to do. So I'm going to drill down on this spreadsheet. I can geek out on spreadsheets when we dig into stuff. So I'm always building a spreadsheet for a client and seeing how it looks. But let me break this down for you. His situation was that he had the debt. He was paying his bills just fine. He did have $20,000 in savings. Now he understood, well, I could take that $20,000 and just put it into the debt and pay down the debt by $20,000, but I haven't really changed much, right? And now I don't have 20,000 in case I need it elsewhere. So we wanted to be careful with that. And so what we decided was, okay, I'm going to drill down on this. Let's see, I'm going to get something to draw with. Okay, so we decided we're going to take, and I kind of outlined it over here. We're going to take the 20,000 that he had. We're going to actually use 15 of it and kickstart his policy. Okay, that's how we started the policy. So it's easy to come up with a strategy to pay the first year. That's rarely the issue. The issue is, how do we keep funding a policy? And so that's this. As we built this out, we had to go, okay, well, yeah, we can take your savings, we can start the policy, but how are we going to have money available to keep funding the policy? We as agents, for you guys, we don't want to create situations where it's not okay in order to start a policy, you need to go get that third job and start working 80 hours a week instead of 70. And then you can get we usually want to find it and make sure it's available within your existing warehouse, if you will. And so that's the strategy. So anyway, so we took 15,000 and we kickstarted a policy. Well, now I can drill down on this. Remember, when you have a whole life insurance policy, you're buying the death benefit, but you also have cash value. That cash value number varies depending on how we structure it, and you can borrow against the cash value. All right. And then you use the cash value. Now that's your banking system, right? That you're starting to make that system work. Use it to make you money or save you money. We've got a good real estate example coming up later as well, how you can use it. And in this case, it's going to be to save us money in the end. So he put in the 15,000 in the policy year one. We structured it so that he could actually borrow 11,000 of it right back out. So I didn't put it on here, but okay, so you think about 15, let's see if this writes, 15 in, we changed the flow of the money. We're putting money in here. And then we took this cash value and we paid off that first debt. All right. Now, why did I do this particular debt? Well, remember, we needed to free up money. He was paying $1,287 a month as a debt payment. And so now we've just freed up $1,287 a month. With me so far? All right. So now we're going to take that $1,287 a month and we're going to put it in an account over here, just a savings account that he was forbidden to touch. It is not there for anything else. Put it in a savings account and leave it there because that $1,287 a month is how he's going to fund all future premiums. Okay, $1,287 a month, he'll put it here, and each year he'll fund his premium. Okay, so now we've solved how do we pay for future premiums? Okay, without having to come up with any extra money out of his pocket. So now we're using money that's going towards a bad debt and creating a good asset. Okay, so just by that one move, we change the flow of the money, and that one move will accomplish that. Okay, so let's move on. Year two. Okay, so we were putting money in here, 15 in that year. Year two, he structured, he could get 14 out. Well, we're going to knock out the next two debts. We have enough, we can knock out the next two debts in here. And you see those go to zero. Now we're going to start what's called snowballing. If you haven't heard of snowballing or aren't familiar with it, it's basically where when you free up one source of money payment, you add it to the next. So we freed up two piles, the 161 and the 73. And then we added those, this one, and this one together to get 335. So we're snowballing these payments to accelerate the payments down on the debt. But what have we done? We're at the beginning of year two, and we've already knocked out three debts just by changing the flow of the money. That's a pretty good rate so far, considering it's going to take 30 years to pay all this off. Okay. And so let's continue. We're snowballing. So you'll see the snowballing payments here. We're continuing the same payments on the next debts. Nothing changes here. Year three comes along. Remember, saving over here. Remember, this money is here. Year three comes along. Oh, he put 15 in. He got more than 15 out. He takes 15 and he pays down the next two debts with it. We're only at the beginning of year three. Okay, so keep that trend going. Let me clear my Picasso art here. Let's go on to the next. This is beginning of year three at the top, you see, and then beginning of year four, we're doing the same thing. Beginning of year five, we're doing the same thing. Boom. We were snowballing, right? We're snowballing the payments. That's how we got to 792 on the final payment. So they were paying 792 on that last student loan debt in this case. By the beginning of year five, we have completely paid off all outside debt. Now, I will use the term debt recapturing because let's be honest, we've been borrowing from our policy to pay down this debt faster by changing the flow of our money. So we're not totally, truly debt free, but we've now repositioned that debt inside of the policy and we've been paying it down along the way. You with me? So now that I'm no longer paying $792 a month on that final debt, let me clear this again. We have accumulated a policy loan balance at the beginning of year, by the beginning of year five. We've accumulated about a $65,000 policy loan that we now need to address. Well, same thing. We were paying $792 a month to bad debt. So we're going to begin paying $792 a month. You see this back to our policy loan balance. You will see the loan balance going down. You will see our cash value going up because now every penny we pay back into our policy is there to be used again on something else. Contrast that with any outside debt, all that other outside debt, right? You pay back your debt if they're loans, you pay back the debt. The only way you get access to that money again is reapplying, requalifying, etc. And at some rate you don't know. And you hope that it works. Or credit cards, you have no control over it. You have no control over what that interest rate is going to be. You don't really, most of us can't even figure out what's that monthly payment going to be. Well, I'm going to rack up $30,000 in credit card debt. I have no idea how to calculate what that monthly payment is going to be, right? These credit cards, because they all have their different ratios. But in that regard, we've given away control, right? We're constantly giving away control by putting ourselves in these financial situations. And the banks dictate what we need to do. And you can get yourself in a lot of trouble, right? So now we're repositioning ourselves. He was on a 30-year plan. We're repositioning ourselves, and he's getting back out of bad debt, and he's building up a good asset. Okay, so let me continue on with this illustration here. So $792 a month. Illustrations, or we will structure them different for everybody. In his case, after 5 years, we were going to reduce the funding of the premiums. So you've got two movements of money when you set this up. You've got premiums coming in to your banking system, and then you've got money going in and out of your banking system via policy loans. Okay, so premiums going in is what I'm talking about. We're going to reduce the premiums going into the policy, and by doing that, we call this the paid up addition. By doing that, he's no longer spending $11,500 a year in the premiums, which is $959 a month. So in this example, we took the $959 a month and the $792 a month, and that equals $1,751. So I'm just in the same light. I'm still snowballing, right? I just took what we are no longer spending on PUAs, added it to what we were doing in loan repayments. So now he's turbocharging his loan repayment, all with existing money. So now he's at $1,751 a month. He's going to continue paying back his policy. You see the debt going down, but you see the cash value, available cash value going up each year. All right, let's move on. By the beginning of year 9, he will be totally debt-free in and out of his policy and have accumulated $96,000 in cash value. So what have we done? We went from 30 years to 9 years, totally debt-free by making one single move. We changed the flow of our money, right? And when we first lay these out, people are like, "There's no way. There's no way. You got some thing in here, and you're tweaking the numbers, right? Because it seems impossible. How do we go from 30 to, and all we did was change the flow of the money. And how much extra money did we do it with? He didn't have to go get another job to do it. He didn't have to go, beg, borrow, and steal to pay premiums. We found the premiums out of existing money. Remember, because he was over here putting it to the side. And he could get 5 years in, right, and change this and go, you know what, I love how this is going, and I'm going to keep funding it more. I'm making more money. I'm going to fund it more. Or, hey, this is the time, year 5, when he reduced premiums. Now I've got a windfall of money. If he's got additional income, that's the time to start your next policy. I'm going to start another one. We'll start another one every time you can. And now you have multiple policies. You have your privatized family banking system. You've got your system of policies going. Okay. So he went from 30 years to 9 years debt free. We're building up cash value. We're paying down the debts, and he got it started. Plus, we haven't even talked about the death benefit that comes with it in this example, right? He's got the cash value, but he's also got the large death benefit that would come with it. Plus, we've talked about other benefits that come with these policies. We have a living benefits rider on here. It's called the Care for Life rider. And there's just so many additional advantages. And now he could have started earlier when he had even 20, 30, 40,000 built up in cash value, but he wanted to get into real estate investing. And so now he's got $100,000 sitting there he could definitely use for real estate investing. And maybe this will be a good segue into the real estate investing, right? You can take this money and start real estate investing. We'll see a good example on this later. And so that's it. That's it. We love sitting down and helping you unpack these things. It's very hard to, and I think I can speak for all the advisors on here that, it's very hard when someone just throws a dollar amount at us. Well, what does this amount do? Well, we can run those numbers for you, but why don't you let us help you more and look at the whole picture, right? What's the whole picture look like for you? You know, look at your income, expenses, assets, liabilities, goals, objectives. We're going to get into all that stuff, and talk about goals and objectives. What do you want to accomplish with this? What can we help you accomplish with this? And by looking at the whole picture, we can get a better idea of how can we change the flow of your money to further enhance what you're doing. You know, I deal with a lot of real estate investors too, and that's the conversation often. I'm like, I don't want to change your investment strategy, your real estate investing strategy. I want to see how the flow of the money impacts that and turbocharges your strategy. And so in this debt example, this was bondage, right? He was stuck. How am I ever going to dig out of this hole? You know? And certainly there's going to be times where we sit down with clients and look at all the numbers in debt situations like this, and it's just not wise to start a policy right now. Let's get your debt down. Let's get that under control. And let's see that you have some capability of being consistent with your money for a little bit. And we'll tell you that, right? We'll tell you this is not the right time for you to do this. You will get yourself in all kinds of trouble, you know, but let us at least look and help you out. So with that, I'm going to kick it back to Yvonne, and
Yeah, I
we'll
see it.
stop for questions.
Yeah, so let's have a couple questions, and this can appear to be overwhelming, right? I see some of the comments. Some of you are like, "Oh my gosh, this is um crazy," but this is the reason why you work with your advisor, you educate yourself. These are the things that we will help you put together. Um, your commitment is to put in your premiums. Your commitment is to fund the policy. Your commitment is to understand the why. Why are you want to pay yourself first? Why do you want to become financially stable? Why do you want to assume your debt? And we will help you, right, with putting this type of system that Jason just showed. That's what working with us looks like, is really, really putting the plan together and achieving whatever goal it is that you guys are looking for. And as soon as you know, you see the bigger picture, meet with the advisor that you came with, and they will help you to drill down in some of these numbers like Jason just showed, right? Any questions for Jason? Any other thoughts? Anything else that before we get into real estate investing with Mike Stevens? Joe, any comments about?
Yeah, if you don't mind, I'll just say a word.
Yes.
What you just witnessed was a very, very high level explanation of why you want an advisor who actually spends so much of our time researching. I'm looking at around my office, and I have years and years and years of research that I've kept. This is not something that you just go online and buy something out of a box, buy something online. I mean, you could buy term life insurance online. And what'll happen is I guarantee you will outlive that term policy because you'll never be able to afford it when you're 90 years old. What we're creating, like I said, very early, and one of the commenters was, "You're telling me that this is a policy that will never decrease in value?" And I was just reminding myself of something that Guy Baker, Dr. Guy Baker, PhD in financial services, wrote years and years and years ago. And he said, the insurance companies figured out that they were mispricing policies. And so they had to reorganize their companies. You know when this happened? 1835. So we're using a model that has, in essence, been successful now since they recalibrated for 190 years. This is not a secret. This is a well-kept secret by the people who want to control our money. And, become a wealthy person is controlling your finances, taking the control back, and realizing how many outsiders are controlling your money. And, I kind of say whimsically, we've done the math. How much wealth will you have when somebody else is controlling it versus how much wealth will you have if you're controlling the money? right? There's another golden rule in Nelson's book. He who has the money, he who has the gold, makes the rules. So what we're teaching, what we're reminding of, is about control. There are so many basic fundamental principles of humanity that we want to remind people about. Control will lead to greater wealth.
Any other questions or thoughts? And Joe, we'll hear from you after Mike to close also and to bring it all together. But now, Mike Stevens, where are you? And if you can, here we go. You are on, my friend.
Can you hear me okay?
Yes, sir.
Very good. And you can see this wonderful PowerPoint.
Yes, sir. I recognize it well.
I say wonderful because the Yvonne Burke put this PowerPoint together for me. I think it's amazing. I've used it countless times. So I think it's an awesome PowerPoint, but the credit goes to Yvonne. I could never do this. But anyway, so Jason, I appreciate the segue, as you said, leading into real estate investing from your presentation. So this is just an option that I want to kind of lay out how to put your IBC policy into action, how to use it in real estate investing, how to create passive income. And I do want to differentiate that from just, investment property or real estate investing, meaning like say, for example, you're buying, I'm a country redneck, so I'm all into the hunting and fishing and where I'm at, one thing is hunting property is a big thing. You can buy, 100 acres of woods and use that as an investment property, but that's not going to create passive income, monthly income for you unless of course, you're renting it out. So I wanted to make that clarification on just investment property. This is cash flow property, rental property, commercial property, what have you, a way to take your IBC policy and put it in the real estate investing. So as I go through this, I want you to just try to wrap your mind or be open to the concept and not necessarily get caught up in the numbers because it can be any number you want. As they've mentioned before, Joe, Yvonne, Jason, as has mentioned, you can move the decibel, you can change the numbers, but just kind of be open-minded to the concept and then you can make it fit your own situation. So I am going to use an example of using a policy with $100,000 premium for 4 years. And then, we're going to drop off the paid up additions right or after that. And it can self-fund and, et cetera, et cetera. And we don't need to go into that. If you have questions with that, you can talk with your advisor about that, but I'm going to skip over that. But so this is using a $100,000 premium policy. And as been mentioned before, in year one, you're going to have about 60% of that available. Years 2, 3, and 4 are going to be totally different. But in that first year, let's just assume 60% of that money is available that you're going to take and go out and use as a down payment for some real estate. So typically for a conventional mortgage or 30-year fixed mortgage, and again, investment property, sometimes you're going to get into the 20 or 25 year, but let's just assume we're using a 30-year fixed conventional mortgage where you're putting 20% down. That $60,000 is going to be able to buy you $300,000 of real estate. You're going to borrow the other 80% from a commercial bank. Okay, so again, just as an example, we're looking at taking our IBC policy, using the cash value available and going out and buying some real estate that's going to produce monthly income. Okay, so for $60,000 available in year one, we're going to buy $300,000 of real estate. Now, when I look at buying real estate, and I have residential investment property, I have some commercial. But one thing that I look at is 25% cash on cash, 5% total investment, or 25% cash on cash. So what do I mean by the 25%? I'm using $60,000 of quote unquote my money, because as I'll get to at the end of this, that $60,000 really isn't my money, right? It's the insurance company's money. My money is sitting in the policy earning a guaranteed internal rate of return. I'm using other people's money, hence the insurance company. I'm using their $60,000, but I want a 25% return on that investment. So I need to find a real estate investment property that is going to net me, and this is after PITI, maintenance, etc. on that property. I want to get $15,000 a year. Now, the first question I get when I go through this, almost every time, is people say, "Mike, wait a minute. Like, I can't find 25% return cash on cash. I can't find 5% return on total investment. It's just not available." Well, it's available. You just need to keep looking. It's available in multiple areas across the country. It may not be in your city. My properties, I can tell you that none of the residential properties are in my city. It's terrible where I live for that. But there's other opportunities, whether it be a different city in your state or a different state altogether, and you can look at property management and things like that. But this is just what I look for as a 25% return cash on cash. So that's what I'm going to use for my example. So again, year one, we go out and buy $300,000 of real estate. I'm getting $15,000 a year net as an annual cash flow. Okay. Now that $15,000 that's coming into my family, I'm going to take that back in and put it into my banking system. Okay, so let's go to year two. In year two, I'm putting $100,000 in, and again, depending on your, age, male, female, or, your rating class, it's going to be close to that $100,000. Okay, for being a male and my age, it's going to be less than that. It's going to be probably in that 95%. But we're going to assume for years 2, 3, and 4. We're going to assume it's 100%, 100,000 in and 100,000 out. That's going to be fairly close. Okay, so year two, I put 100,000 in. I have 100,000 available plus the 15,000 from the real estate property I bought in year one, right? Because I'm netting 15,000 a year. So my total available to go out and redeploy or to purchase additional real estate in year two is 115,000. Okay, and to be conservative, let's just use 100,000 of that. Okay, so in year two, I'm going to go out and I'm going to figure a 20% down payment, 30-year fixed conventional loan. I'm going to be able to get a $500,000 piece of property. Or, let's be honest. Maybe that's two properties. Sorry, those are my dogs, if you can hear them. Maybe that's two properties at 500,000, or one 200,000, or one 300,000, or apartment buildings, or what have you. But let's just say $500,000 of investment property. Again, I'm looking at a 5% return overall, or 25% cash on cash. So $100,000 down. I want 25% or 25,000 cash back on that property or properties. So again, that $25,000 comes back into my banking system. I'm adding that with the $15,000 I'm getting in the property in year one. And that's a total of $40,000 that I have generated in 2 years. So again, that $40,000, one thing I want to interject here. When you look at the base of this policy, what Yvonne had laid out when designing these on a 60-40 blend, the base of that policy is what? Anyone? Is anyone still here?
40,000.
There we go, 40,000. So in 2 years, I have generated cash flow of $40,000. That will pay my base for that policy for the rest of my life, should I choose to do so, just in 2 years. But let's go on. I want to go through the first 4 years of capitalization. So in year 3, I'm going to put $100,000 in. That $100,000 is going to be available. Plus, I'm going to take the the $40,000 that is coming in passively from my real estate portfolio, if you will, thus far. $40,000 a year. So now I have in year 3, I have $140,000. I can go out, get a conventional loan, put down 20%, buy $700,000 worth of property. Again, 5% overall, 25% cash on cash. That's going to generate another $40,000 a year. You add that to the, $35,000 a year. You add it to the $40,000 a year I'm already making from the other real estate. That's $75,000 a year of passive income. Year 4, 100 in, 100 out. We add 75,000 to it. Now I have $175,000. I can go out now and purchase more real estate. So again, using 20% down. Now here I'm using 180, 80, even 175. So go back up to year 2 where I had another $15,000 in my system that I really didn't use. But to keep the numbers even, I'm going to use the $900,000 purchase, or again, multiple properties. It doesn't matter. 20% of that is 180. So I'm going to kind of use $5,000 from year 2 there just to keep it simple. But again, 5% there, that's 45,000. 45,000 on the 180. That's 25% return. You add that to the previous $75,000 a month from the first 3 years. So in 4 years, just 4 years, I have created $120,000 of passive income in just 4 years. Now, again, if you want to look at, okay, well, I want to use that $120,000 to pay my base every year after that. I can take 40 out of that for the base. I have another $80,000 of passive income. Or I can go out and take that and I can purchase more property, start a second policy. I mean, there's multiple options you have after you complete 4 years of doing this. But this is a way to use your banking system really with just one policy and use it into real estate investing. So now, again, let's look at what we've done here in 4 years. We put in $100,000 a year for 4 years. We've invested a total of $400,000 and created $120,000 of passive income. That's 30%. 30% return on what we've put in out of our pocket. And I always like to point that out because one other question that we all get from people is like, so what's the guaranteed internal rate of return in the policy? It has nothing to do with it. It doesn't matter whether it's 3%, 4%, 5%, 8%. It doesn't matter. When you can use that to generate a 25, 30% annual return, I don't care whether it's 4% or whether it's 5%. It makes no difference to me. As Nelson says in his book, the rate doesn't matter. Okay, it's all about the volume. Now, just to address real quickly on this $400,000 we put in here, and Jason did a great job of pointing that out in his presentation. That $400,000 we put in, we've turned around and taken out $360,000 of that and used. That's the insurance company's money, and technically that's a loan. Okay, but let's say it's 4% and it's a $400,000. That's $16,000. Okay, say it's 5% and just round it off as an even $20,000. You could take the $120,000 of passive income, take 20 of that, and service the loan or pay the interest every year for the rest of your life. Interest only loan. Again, you're the banker, you're in control. You can do whatever you want. And then that will leave you $100,000 of passive income a year for the rest of your life. At the same time, building equity, utilizing depreciation, the tax write-offs, et cetera, on the real estate side, as well as growing your policy on the IBC side. So benefits, I've kind of hit some of these, an additional $120,000 of passive income, the death benefit you have growing every year, tax-free dividends, year 5, you can go out and buy more properties. You could retire, you could dump it back into your paid up additions, like lots of options there. Flexibility, being the own banker, credit protection, living benefits, disability, I think Yvonne mentioned. And when you go back and look at let's just say I'm going to go out and do real estate investing without IBC. I'm going to go out and buy the same portfolio of properties, and I'm going to put $360,000 of my own money in for the 20% down, and I'm going to do that. So my question is, okay, what happens to you? What happens to your family? What happens to your portfolio if 3 years in, tragically, you die? Well, you have the mortgages on those properties. No one's there to management. My wife certainly doesn't want to do it. I mean, there's all kinds of things that are going to come into play there. However, if you're running it through your IBC system first, there is the death benefit there. And as the second point illustrates here, it's growing every single year. It's getting bigger and bigger every year. So basically recession proof. And should something happen, that is going to take care of all of the mortgages and then some that you can then pass on to your beneficiaries. So I don't know how long that went, but are there questions, or I guess I'll just turn it back over to you, Yvonne.
Thank you. Any questions or anything, any thoughts? And again, right, the idea around this is to show you the flexibility. The idea around these examples is to show you whatever vision you may have. I think it was Jason said earlier, forget the zeros. Make that a 10,000, make it 1,000, make it 1,000,000. It doesn't matter. The process of being your own banker is exactly that. It's a process. It's not a product, right? Is maximum capitalization, is maximum utilization, is understanding the most effective way to use that dollar to create more cash flowing assets. That's wealth creation. If you remember when Joe was talking about the annual pattern of spending and talking about how we buy things, right? That wealth creator line, this is how it gets achieved. Okay. Any questions, comments? Do we see anything on the chat? If not, or any of the advisors want to add anything else before Joe takes over? Thank you, Mike. That was very, very good. It's up to me. It's as long as we've been doing this, right, Joe? And I say that all the time. I learn something every time, even though we've been doing this for however long we've been doing it. It's amazing how the different ways and the different things and the different visions that you can have when you're creating these systems. Joe?
Thank you, Yvonne. It's absolutely true that I learned something every single day from someplace, from somebody, from something. And I've learned a lot today just from listening to my own colleagues. And let me just point out one thing of many that I've heard and reheard. And sometimes you hear things in just a little bit different way. And I want to point out one comment that Mike Stevens made when he was showing the example of using your family banking system to buy real estate, and especially cash flowing real estate. I think, Mike, you said at the end of year 2, you've created enough cash flow from real estate on a net basis to fund your policy for the rest of your life. I mean, that was a powerful statement. And it's the opposite side of the coin from the question that many people have asked me when they say, when can I stop paying this thing? How soon will this policy pay for itself? Boom. They missed the whole point. What they're really asking me is, this hurts. I hate it. I hate life insurance. I hate premiums. I hate outlay. When can I stop this? Here you go. Don't start it. Right? If it hurts, if it's the wrong thing for you, don't do it. But what Mike just explained, see, we're marrying the concept of controlling your own finances as opposed to allowing somebody else to control them. The banks, the credit unions, the lenders, the credit card companies, the SBA, and on and on and on. I mean, look at your finances. Take a deliberate look at your finances and calculate how much of your money is going to outside forces. 35% of your take home is going to interest, your cars, your credit cards, your mortgages. I have a very close family relative who's well set, who pays in excess of $2,000 a month in car payments. Why does he pay $2,000 a month in car payments? Because he can afford it. And I pointed out to him, you can get a more attractive rate, and I don't talk about rates a lot, but you can save yourself money. Nelson talks about the difference between rate of return and volume of return. We can't retire on rate of return. Oh, I'm getting 8% in my portfolio. Well, is it every year? Well, no, some years I lose 15%. Okay, well, then you're not retiring on that rate that year. All right. There's the difference. Rate is a number, volume is a number of dollars. Okay. I said to my friend, you have enough cash, more than enough cash in your life insurance policies where you could pay off your $100,000 worth of car loans and cut your monthly payment by 70 to 75%. Listen, I'm not comparing apples and oranges. You're paying an amortized, which is a principal and interest payment over $2,500 a month. Or you could pay interest only for $800 a month. It's your call. Here's the math. Would you like to free up $2,000 a month and pay that loan back if you want to, when you want to? The interest rate will never increase. Your policy will do nothing but increase as long as you're paying premiums, and as long as you're paying loan interest, you have no loss whatsoever. And he said to me, he gave me a very technical answer. He said, duh, where do I sign? Okay. Now, this is a client and a family member who's been a client for 15 years or more. And I'm saying that to remind you, you're not going to get all this in one dose. This is only going on 2 hours now. You guys are way too efficient with your time because now you've left me the ability to get dangerous and talk for the rest of the hour. We might just end early if there are no questions. But I want to communicate to you, it's not about the rate of return that you get in any product whatsoever. It's about how you use the product. See, the clients who say to me, when can I stop, are operating on a scarcity mentality. Life insurance is bad, so I want to stop doing it as soon as possible. Well, what if you're making yourself wealthier and wealthier and wealthier and buying more assets that create cash flow? When would you want to stop that? Never. There you go. Right answer. So the clients who are getting it are saying, well, you know what? I bought a car much more efficiently. You know what? When I went out shopping for the car, I didn't have to worry about the price I was paying because I was going to get all my money back. And I hope I remember to say this again and again, even before the end of today, is this is about control. This is about controlling your finances and controlling your life and controlling your future, as opposed to giving the control over to somebody else. We as Americans have handed over control of our lives to the people who control our money. And by the way, it's our money. If you take back control, then you will control your wealth. If you control your wealth, you'll have more wealth. If you control your wealth and improve on your wealth and multiply your wealth, then you'll have more freedom. If you have more freedom, then you'll have more choices and more options. And guess what that will give you? More control and more wealth and more freedom. It multiplies itself. If I can share my screen,
Yeah, you should be able to. There you go.
I'm going to talk a little bit more about putting infinite banking concept into action. Now, again, I'm the old dog here by many, many years. I'm the poster child for the banking system, for using whole life as a foundation for your banking system. You can use a savings account. And if you have $1 million in your savings account, God bless you. You are a genius. I don't care what anybody else says to you. Don't let anybody take that away from you. If you build wealth in a unique way and you're taking care of yourself and your family and your posterity and your causes, I don't care where you built your wealth. I don't care where your risk is. If you've gotten control and you've gotten over that learning curve and you've overcome Parkinson's law, and you've got $1 million in the savings account or under a mattress or in a pillowcase or in a shoebox, I don't care. You're a genius. We're just saying for ordinary human beings, this works. It only works if you observe the rules. And the rules are very simple, right? And these are rules that you'll learn from reading the book or from listening to us ad infinitum. You will get tired. You'll get sick and tired of hearing us tell you the rules. Don't 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 be afraid to think long term. The biggest problem with asking about rate of return, rate of return, rate of return is everybody wants to know what the rate of return is going to be this year. And so I asked my friend, what's your rate of return on your car payment? What's your rate of return on your car, on that $80,000 Mercedes or BMW or whatever it is you're driving? What's your rate of return? It's a ridiculous question. There is none. What's the rate of return on the banking system you use to finance your car? Most people would say, well, I don't know because it doesn't belong to me. I'm saying I know because mine belongs to me. Okay. Here's an example. This is a real life example. Now, remember, I cheated because I started owning banking policies well before I knew how to use them. I started owning whole life. I probably canceled the first two or three policies I bought in the 70s, and I still have a portfolio that's growing. This is an example of a car that's pretty close to the actual car that we bought for my wife, my business partner, my licensee, and my agency. Love of my life for the recording's sake, and the angel I'm walking through life with. We bought a 42 or $43,000 Lexus in 2003. Now, I have at the bottom of the screen to remind you, to remind you, to remind you. Whereas we had the Saver before and Bank of America, the 600-pound gorilla in the middle, I don't have that. You are the saver. You are the banker. You are the borrower in this scenario. If you control all three bases, do you have more money or do you have more money if somebody else control it? You already know the answer. So with my portfolio of policies, way more than four, I took a policy loan. I took the money from the insurance company. I took it and lent it to my agency, which is Alpha Mega Wealth, my wife being a happy recipient. And I came home and I said, honey, I have great news for you. I'm charging you 12%. This is going to go kind of next level, right? Wait a minute. What do you mean 12%? Are you crazy? I got a car loan for 7%. Yeah, but the only thing is you're going to pay 12%. And we're going to send the insurance company 5%, which is the cost of the money the cost of the loan because we're not taking the money out of our policies. We're taking a tax deductible 5%, which probably cost me maybe a 3.5% net. Not important, but I'm borrowing at a reasonable rate. And guess what? We're also going to send an extra 7% because when you control the banking system, you control the rules, you will make more money. I didn't have to pay an extra 7% back to my policies, but I chose to. Why? Because the more money I put into my policies, the more they expand, the more control I have. So the next time I want to buy something else, I can finance that. Up at the top here, you'll see my growth um, chart here. I paid back the $42,000 to the insurance company. No question about that. I borrowed the money from them. I paid them back. But guess what? It was against the equities in my life insurance policy. So while I was paying the insurance company, the growth in my policy was more than I paid them back. I also got a very modest tax deduction, which I took off of my taxes because there was a business loan, a car loan, which was related to business. And I also have, if you want to count pennies, I also have the salvage value of that vehicle. So I borrowed $42,000. On my balance sheet in real dollars, I got 75,000. How did I cheat? These policies were set up long before I needed the loan. So I already took a mature policy. This 75,000 did not include the value of premiums that I was adding to that policy. If we add that number, it would be well above $100,000. See, because if you know that you're controlling your own future, controlling the banking system, you don't care about how much money you put into your policies. I want to, I love the word that somebody used in describing my banking system. They said, Joe, you're paying obscene life insurance premiums. Yes, thank you. Appreciate that. We have about 30 policies. And I'm not saying that you should follow me. My colleagues here, some of whom are my students and disciples, my team members, people I love, you guys are going to run rings around what I do. The student should always surpass the teacher. Okay. Do you follow the model? Anybody not follow it?
And you own the title to the car.
There you go. Salvage vehicle of a car. I'm able to reuse it. Look at that. I bought a $42,000 car, got $7,000 out of it. But where did I make the money? In the financing system. You know, if you buy a house, your contractor makes money. Your realtor makes money. Who makes the most money when you buy a house? The mortgage company. The bankers always make the most money. We're just saying, if you want to have more money, become a banker. I've expanded this system. I'm the saver. I'm the banker. I'm the borrower. This is my own little modest system. Many of my clients have systems that are way bigger than mine. It doesn't matter. That where you put your decimal point doesn't matter. And who is eligible, who will benefit from a model like this, a philosophy like this, a thinking system like this? Anyone. What no somebody asked Nelson Nash, what is the downside of the infinite banking concept? You know what his answer was? Not doing it. I mean, we've done the math. More money means more control, means more freedom. You want to keep on working with banks? This is America. You have freedom of choice, right? I've used this program, this model, this way of thinking to build um, my uh, my family's wealth, our generational wealth. I'm continuing to teach my kids how the model works. They'll have to continue to absorb it at their pace. And not every child of a banking owner is going to follow their model. They can or they cannot. Fortunately for me, I've built in controls, shall we say, control from the grave. My kids don't have to use my banking system, and they also don't have to inherit my money. So, nobody's forcing me to leave an inheritance. Nobody's forcing them to honor the banking system. If you take a loan, you pay it back. Nelson's rules. Don't be afraid. He fights. He combats fear every single day. Don't be afraid to think long term. Don't be afraid to capitalize. I mean, I'm putting stupid money into my program. You know why? Because I know I have control of it. I showed you that list of 500 banks that have just failed just in the past 20 years. Life insurance companies are boring. They don't lose the money. We haven't even gone into the the Austrian economics discussion and the differences in the schools of thought. Banks are leveraging their profits off of our backs, and they're creating velocity with money that they don't own. They have no margin. They have no asset backing up their liability. They're actually lending more money than they own, which is a ridiculous idea. Fractional reserve lending takes the authority from the U.S. government to the Federal Reserve to the banks, and they can literally lend more money than they have. If it sounds ridiculous, it's because it is. It's smoke and mirrors. He says, don't be afraid to think long term. Don't be afraid to capitalize. Third one, don't steal the peas. If you take a loan from a bank, don't you pay it back? I know I do because I gave my word. I signed a document. Don't steal the peas. Now, if you take a loan from your savings account, do you pay it back? No, you don't. And this is where the clients that we have who are thriving, who are successful, have overcome the tendency and the temptation to take money out of their system and not pay it back. Why should I pay it back? Because you want to use it later. You want to use it again. When you need it again, it's going to be there. Not only will the repayments be there, but I'm going to recapitalize and capitalize and capitalize until the day I graduate, because I never want to give up control of my finances until I'm no longer physically or mentally able. So if you take a loan, pay it back. Not only pay back the cost of the loan to the insurance company, pay back excess. So where does the excess go? Right back into your policy, right back into your bottom line. Don't steal the peas. Nelson's rule number 4, don't do business with banks. I mean, you can, but you're feeding into their profits. They are not here for your betterment. They are not here for your welfare or your health. I mean, I spent 45 years in Las Vegas. I did not give the house my money. You can go to Vegas every single year and lose $10,000 and go home, and you're going to go home $10,000 poorer. Guess who wins it? The house. Same as the banks. The house wins. He says, don't do business with banks. There are so many reasons we haven't even talked about today. What's rule number 5? Rethink your thinking. Rethink every single financial decision in your life and ask yourself, is this putting more money in my pocket, my family's pocket, or in the outsider's pockets? Banks only have one interest, and that's getting your money today, tomorrow, the next day. And the last rule that I learned after Nelson died, which his son-in-law David Stearns, who runs the infinite banking concept and the Nelson National Institute, reminded us of. He says, "Don't be afraid to make room for windfalls." How many of you have had windfalls happen in your life? You get a bump in salary. You get a new job with a signing bonus. You sell a piece of property at a profit. You saved up excess money because you thought you were going to have to pay extra taxes, and you wound up not having to pay extra taxes from my lips to God's ears, right? Windfalls. What happens with a windfall? The first thing that people think of is, where can I spend that money? What can I go and buy? What extra trip can I take? You get the idea. So I'm going to say it until it just sinks in, until you get tired of hearing it. You'll never get tired of being in control. I'll tell you that much. Being in control is much more pleasurable than not being in control. You control the saver, you control the banker, you control the borrower because they're all you. You control the banking equation. You create wealth. Start small, start medium, start big. Many, many clients, after months and months and months in the first year, come back and say, I bought a policy from you and it was too small. I need another one. No problem. You need one on yourself. You need one on your spouse. You need to look at your parents. Don't overlook if your parents are decently healthy and can pass a physical. Don't overlook insuring your parents. Ask your parents if they're in that position, hey, how would you like to leave your grandkids an inheritance? And they might say, well, I'm not in a position to do that. Well, you can if we took out a small life insurance policy on you, or medium-sized life insurance policy. I'll pay for it. It'll take care of your final expenses, and it'll create an inheritance for the kids, and it help seed or extra seed the kids' policies. And now we're creating a generational system, the simplest system in the world to create a millionaire mentality and to start teaching the rest of our family members and our kids and our grandkids how to become their own banker. Having your kids take loans against policies to buy, I don't care, their first bicycle, to fund their first year of college, to fund their first very modest car. The uses obviously are endless. Okay, so we're early, and we are open to Q&A, and I'm happy to give the time back if and when we answer the questions that we can answer.
Yeah, anyone that wants a question, I don't see any questions on the chat per se, but if anyone has any questions whatsoever, now it's the time. I think there's a couple of QR codes that we want to share, I think, Joe, right after this also.
Sure. You talking about the book, Yvonne?
Yeah. So here's a QR code to, we keep reference the book every, throughout the morning, and here's where you can get it. You can get an Audible. You can, the first step is going to be meet with the associate that invited you here, right? Start that conversation. Let's look and see how we can help you, build this and answer whatever questions you may have. If any of the other advisors here on the call have any other thoughts or anything they wanted to add, let us know. Any of you guys out there? Any final thoughts?
I'm just going to touch on this one asset map that we have made available to our clients. And many of my clients, whether they make a lot of money or a little bit of money, have said to me, I don't really have a balance sheet put together. I don't have on paper a very simple, concise view of my income, my outgo, my assets, my liabilities. I kind of have a general idea of what they are, but number one, I don't have them listed down. I don't have my documents organized, and I don't really have, in general, kind of a forecast how I could look at these assets that I have and kind of foresee what they might create for me in the future. So that's something that we can help you get organized. It's this is called an asset map, and we can start with this. Many people stay with this. Some clients, as they start to accumulate more assets, need a more sophisticated tool, which we do have available, which I won't go into today. Some of my clients receive a 90 or 100 page report.
No license.
Sorry?
License is spelled License.
Oh, we need to mute. Starla, can you mute your?
Oh, sorry, I'm talking to Alexa.
It's okay.
No worries. So if you'd like to help get organized, get help getting organized in your finances in a very simple way, we can help you with that. Um, we showed you the book. This is just a very small listing of books, most of which are ebooks that we can get to you. Not becoming your own banker, but The Law is a wonderful book that everybody should read. Life insurance as an asset class is probably the most boring book you'll ever read, but some people who are analytical, CPAs, engineers, like to look at the technical, analytical, mathematical aspects of whether a life insurance policy works out in the context of a market portfolio and a financial portfolio. Obviously, if the answer wasn't yes, I wouldn't be putting the book up on the board. But in the back of Nelson's book, there are 2 or 3 pages of suggested reading. And if you ask for a direction on that, we will direct you to the top 5 or 10 or 15 books that you should make part of your library, and you should open them up and dig into them.
Perfect. Any last questions or anything at all? Like we said, schedule your one-on-one consultations. Where Joe and I are always available to meet with any of you as well. Get the book. I also have for us, we're always trying to improve our presentation, improve the way that we, try to teach this concept. So you're going to receive here shortly a kind of like a little questionnaire with some feedback for you guys to tell us how we did, how we can do better, how we can, be able to go over this information in a better way for our clients. So we would appreciate you participating.
I don't know if you answered this question, and maybe I missed it. Somebody wrote in the chat, I think, can I use the infinite banking concept with an existing policy? Oh,
Yes.
that's music. That's music to my ears. Absolutely. You can use the infinite banking concept model and philosophy and thinking with any asset, primarily with a life insurance policy. We'll show you how to do that. I mean, I love it when people have existing policies. Quick example. I'm working with a new friend. She goes to my church, and I asked her if she had any life insurance. She said, well, my father bought a policy on me when I was a kid. She's had the policy for 40 years. It's a very, very modest policy. I mean, it's a small policy, and she hasn't thought about it. In the conversation, I come to find out she has a car loan. Well, what's your car payment? Well, car payment's $600 a month. Well, that's kind of steep. Well, she just sent me a copy of her statement of her life insurance policy, which, by the way, she's never paid attention to, didn't know how to read it. And we found out that her life insurance policy has $25,000 of cash in it. Now, that doesn't quite cover the $30,000 car loan, does it? But it gets you really, really close. Gee, I wonder if there is someplace else where we could identify $5,000, add it to the 25, pay your car loan off. And now we have a $25,000 loan against your policy. Well, what's 5% of 25,000, class? $1,250. Yes. That's about $105 a month in interest only. Again, we're not comparing apples to apples. I'm comparing a principal and interest loan of 600 to an interest only loan of 100. Now, you can do what you like. You could keep the car loan and pay it off when it comes to completion. Or you can save some of your cash flow today and move your car loan over. Somebody said it's recapturing, right? We're taking the loan back from that car loan company. We're not wiping out the loan. We're moving that loan, recapturing it into our own system. And because of that, we're supporting the banking system that resides inside our life insurance policy. I don't know. Let's take a vote. Go to chat. Would you rather have a $600 car payment or 100? I'll wait. Okay, I waited long enough. I'm a financial planner. I got letters after my name. The answer is 100. Okay. If you don't know what to do with the other 500, that's why you need us. Okay.
Awesome.
And that is not, I mean, that's not the end of our examples. I mentioned in the chat that I had an 83-year-old walk in and desired to buy an extremely large life insurance policy, who was very, very healthy, who was a master senior tennis player, who played tennis every single day, who was really, really healthy until he wasn't. And he used his banking system in the interim. He died unexpectedly. He, Nobody expected this guy to die at only 93. I thought he'd be kicking my butt on the tennis court until he was 105 at least. But things happen, right? God's got a sense of humor. And his wife was able to receive the windfall of not only the life insurance death benefit, but also the assets that he had supported during his lifetime and created a whole lot of security and stability and safety net under her life going forward. And that's a very unusual situation. We've had very, very few people at the age of 80 walk in and want to buy a life insurance policy that's going to have some meaningful effect in their life. But it does happen. And that just goes to prove that this system can be used, this model. System's not a good word. This philosophy. I love the word concept because concept exists in your mind. And that's where all the creativity and the imagination are. So I could continue, but if there are any last questions, I'd love to entertain them. I want to thank you, colleagues, for presenting today and for being available and for your diligence, for your care, for your love for the folks who showed up today, and for being available for their every question and for your willingness to help them create wealth with their own family.
Thank you, everyone. Please take the time to get some feedback to us and have a great day. We look forward to meeting with all of you.
Thanks a lot.
Thank you, Joe.
Bye,
Thank you.
guys.